Breaking development. Silver just crashed 12.22% to 77.39. MCX silver hit lower circuit at 280 lakh rupees per kilogram. This is the second crash after yesterday's failed bounce from $89. But here's what's happening behind the scenes that nobody is connecting. While Western paper silver crashes to $77, physical silver in Asia is still trading at $104 to $130. That's a 40 to 70% premium over paper price. And JPMorgan data confirms 633 contracts delivered at the $78.29 bottom. Let me show you what this means. Yesterday, we saw silver bounce from Monday's lows back to $89. Today, that entire bounce was wiped out in hours, down 12.22% to $77.39. Anyone who bought yesterday's bounce at $87 to $89 is now sitting on double-digit losses in less than 24 hours. That's a classic bull trap. Price recovers just enough to pull in buyers, then collapses again. The pain is real. The frustration is justified. Quick note for my new viewers. This channel has not and will not ask for money. Anyone doing so in my name is a scam. This is factual analysis with verified data, not hype. Current prices, as I'm recording. Silver Western spot $77.39, down 12.22%. Shanghai spot $104. Shanghai futures 90 down 89. So that's a $22 to $27 premium, 28 to 35% premium over Western paper price. MCX silver in India hit lower circuit at 280 lakh rupees per kilogram. Lower circuit means trading was halted because price fell so fast. When exchanges halt trading due to downside limits, that's not normal price discovery. That's stress in the physical system. Let's connect this to yesterday. Silver rallied from Monday's $73 lows back to $89. That's a $16 bounce, 22% recovery in 2 days. Everyone thought the bottom was in. Then today hits, down 12.22% in one session, back to $77.39. Every buyer from $83 to $89 is now underwater. The $89 level that held yesterday became a bull trap today. This is the second major crash in a week. Monday saw the initial collapse from $97 to $73. Then Tuesday and Wednesday rallied back to $89. Thursday erases the entire recovery. What pattern do you see? This is systematic liquidation followed by false recovery followed by renewed selling. Each bounce attracts new buyers. Each crash liquidates them. Rinse and repeat until all weak hands are gone. But here's what the paper price is not showing you. While Western silver crashes to $77, Asia is still paying $104 to $130 for physical metal. Shanghai spot at $104. Reports from dealers in Singapore, Hong Kong, and Dubai confirming prices between $110 and $130 for immediate delivery. Paper silver in New York, $77. Physical silver in Asia, $104 to $130. That's a 35 to 68% premium for actual metal you can hold. If silver is truly crashing due to lack of demand, why is Asia paying double? If supply is abundant as the paper price suggests, why are physical premiums at record levels? Paper and physical are two different markets. Paper can be created infinitely through derivatives. Physical has to be mined, refined, and delivered. Paper reflects leverage and positioning. Physical reflects supply and demand reality. And right now, they're telling opposite stories. Paper says panic. Physical says shortage. Both can't be right long term. Now the JPMorgan data. 633 silver contracts were delivered at the $78.29 bottom. That's 3.165 million ounces of physical silver demanded for delivery at the exact moment paper price was collapsing. Normally, less than 3% of futures contracts result in physical delivery. Most traders roll positions or close for cash. But at the bottom, 633 contracts stood for delivery. These are not speculators. Speculators close positions during crashes. These are buyers who wanted physical metal and used the crash as accumulation. They bought paper at $78.29 and immediately demanded physical delivery. This confirms what we saw Monday. While retail panicked, someone was accumulating physical. Paper crashes, physical deliveries spike. Let that sink in. The crash wasn't retail giving up. It was a liquidation event that created opportunity for physical accumulation at suppressed prices. JPMorgan, one of the largest precious metals dealers and COMEX vault operators, processed 633 delivery contracts at the bottom. That's institutional accumulation disguised as a crash. Here's the part nobody is asking. If demand is collapsing as paper suggests, why are physical premiums in Asia at 40 to 70%? Why are 633 contracts demanding delivery at the crash bottom? Why did MCX hit lower circuit, meaning demand was so strong the exchange had to halt trading? These are not signs of collapse. These are signs of a two-tier market. Paper tier for leverage. Physical tier for actual supply and demand. And the physical tier is screaming shortage while paper crashes. The Indian MCX hitting lower circuit at 280 lakh rupees per kilogram tells you the physical market in Asia is not following Western paper. Lower circuit means maximum downward movement was reached and trading halted. But even at lower circuit, buyers were still trying to get in. That's not bearish. That's physical demand so strong that even at daily limit down, there are still buyers. Meanwhile, paper silver in New York trades freely at $77 with no circuit breakers. Asian physical and Western paper are operating in different realities. Shanghai silver spot at $104, while Western spot trades at $77.39, creates a 26.61 arbitrage gap. In normal markets, arbitrage closes within hours, but this gap has persisted for days. Why? Because you can't easily convert paper silver into physical for Shanghai delivery. Paper is derivatives. Physical requires actual metal. If you buy COMEX at $77, you can't just ship to China and sell for $104. You need delivery, transport, customs, and buyers. That takes weeks. This is why the gap persists. Western paper sets global reference price. Asian physical pays premiums based on local supply and demand. And right now, Asian demand is so strong the premium is 40 to 70%. That's structural shortage disguised by paper suppression. Let's talk about what this means for anyone holding silver. The bull trap at $89 hurt. The 12.22% crash today hurt worse. If you're sitting on losses, the emotional response is cut and run. But before you do, ask this. If silver is finished, why is Asia paying $104 to $130? Why did JPMorgan process 633 deliveries at the bottom? Why did MCX hit lower circuit on the downside with buyers overwhelming sellers? The pain is real. The losses are real. But the disconnect between paper price and physical reality is also real. Paper can be manipulated through leverage and derivatives. Physical cannot. You either have metal or you don't. Right now, the physical market says metal is scarce and demand is relentless. The paper market says the opposite. One is lying. Here's the risk. If you sell now at $77 and next week silver is back at $95 because physical shortage forces repricing, you locked in losses at the bottom. But if you hold and silver crashes to $65, you sit through more pain. Nobody knows short term. Paper has unlimited ammunition through derivatives. Physical has limited supply and rising demand. Which wins next week is unknowable. Which wins long term is obvious. Physical reality always overwhelms paper manipulation eventually. The 633 contracts delivered at $78.29 represent 3.165 million ounces removed from the system at crash prices. That metal is gone. It's in Asia or private hands, not coming back to COMEX. Meanwhile, COMEX registered silver continues declining. Each delivery tightens supply. Each crash that triggers physical accumulation accelerates the tightening. The paper market thinks it's winning by pushing lower. The physical market is using those prices to drain the system. 3 scenarios for what happens next. Scenario 1, paper continues lower. Silver tests $70 or $65 as longs get flushed. Asia keeps paying premiums. Physical keeps leaving. Eventually, COMEX registered falls to critical levels. Delivery concerns trigger short squeeze. Paper explodes higher. This is slow bleed into explosive repricing. Scenario 2. Paper bottoms here at $77. Consolidates for weeks. Asia premiums stay elevated. Physical shortage becomes undeniable. Price grinds higher back toward $90, then $100. This is stabilization and recovery. Scenario 3. External shock. Geopolitical event. Banking crisis. Currency collapse. Safe haven demand surges. Physical unavailable at any price. Paper dislocates from physical. Silver trades $77 on paper, $200 for physical. COMEX defaults, or cash settles. This is systemic break. Nobody knows which unfolds. Your decision to hold, sell, or buy depends on which scenario you think is likely and your time frame. Here's what we know with certainty. Silver crashed 12.02% today to $77.39. MCX hit lower circuit, second crash after failed $89 bounce. Anyone who bought yesterday is sitting on losses. That's paper reality. But Asia paying $104 to $130, $40 to 70% premiums. 633 contracts delivered at $78.29, JPMorgan processing physical at crash prices. MCX lower circuit means buyers overwhelming sellers. These are physical realities. Paper says panic. Physical says shortage. Both can't be right. One is manipulation, one is truth. If you trust paper, you sell and wait for lower or exit. If you trust physical, you hold through pain or accumulate at suppressed prices. There's no universal right answer. Your risk tolerance and conviction determine your move. Every major bottom in silver history has been marked by extreme volatility, failed rallies, and capitulation. The 2008 crash saw silver fall from $21 to $8 before rallying to $49 by 2011. The 2020 COVID crash saw silver drop from $18 to $12 before rallying to $30 within months, both marked by bull traps and maximum pain before reversal. This crash to $77 after failed $89 bounce fits that pattern. But patterns don't guarantee outcomes. The unresolved tension is this: paper at $77, physical in Asia at $104 to $130, JPMorgan delivering 633 contracts at bottom, MCX lower circuit on physical demand. Second crash after failed recovery. Does paper force one more leg down to $65 or $70? Or does physical shortage force repricing here and we never see these levels again? Paper has momentum to push lower. Physical has shortage to force higher. Which wins short term is unknowable. Which wins long term is physics. Paper is infinite. Physical is finite. Do your own due diligence. Understand the risks. The bull trap was real. The 12.22% crash is real. More downside possible. But Asia paying $104 to $130 is real. JPMorgan's 633 deliveries are real. MCX lower circuit on buy demand is real. Physical shortage accelerating is real. Paper pattern and physical fundamentals moving opposite directions. Know your time frame. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. OG out and about.